Hi there, just read this disclaimer please.
Alright folks, so just a very quick update hopefully. I just wanted to let you know what I've been doing since I sold Hint, which is the last update I gave you guys. So basically a couple of days before the end of the tax year, I sold, I think it was about 1500 quid-ish worth of Fundsmith. It's basically the last little bit that wasn't inside the ISA I sold so that I could realise the gain before the tax year end on the 4th. And then a couple of days later, just in the new tax year when I got my new ISA allowance, I put that roughly £1,500 into Scottish Mortgage. So done some tinkering there. So if we go to the capital gains tax information spreadsheet that I have, we can see there's the 300 quid that I added to the tax year before. As you can see, I still didn't get that close to the 12 grand or whatever it is allowance. After I top that up, it's basically most of it has just been moving the Murray International Trust from my iWeb unsheltered account, so taxable account, and putting it into first of all the LISA. So I got the bonus for the LISA about the 24th of May. So I sold about 5,000 and a couple of hundred, I think, because there was dividends from the previous year. Sold that sold that in the general investment account, and then bought back the same amount roughly in the LISA. And then I did exactly the same thing with the SIP as well on the 23rd of June. And then today I got the last, I think it was 8,500-ish out of Murray International. Sorry, that's the buy, isn't it? I sold the last amount out of Murray International and bought it in the ISA. So that means that now in the general investment account I've completely got rid of Murray International, which was the only one that had like a decent percentage gain. I think it was about a 20% gain when I did it today, which is good because it was actually higher. It was good to have a low ebb in the market to do it on, because you get more of the shares in the ISA for the amount of ISA allowance you're using. So what's left over now is just really scraping the barrel. It's all of my worst investments, because obviously each time I move something from unsheltered to sheltered from tax, I'm always picking the stuff that's done well so that I can realise the gains. So it makes sense that everything that's left over is in the red. So I don't think there's going to be any trouble over the next few years getting all of this into the LISA, the SIP and the ISA without any capital gains tax being paid, I would imagine. Okay, and then the last thing that I did today as well was this started, I think it was, let's go to the unitisation spreadsheet. So as you can see, this started, probably a couple of weeks before the 8th of June, but on the 8th of June, I took the decision to add 6 grand to the portfolio, because I'd done a few months of living abroad, sort of travelling around, living abroad. So I've got some confidence about how much money it's going to cost me. So that gave me some confidence. But also this worst case scenario planning spreadsheet has progressed. I've saved up some more cash by not spending very much. And the dividend projection has gone up as the trusts have increased their dividends. Also what's happened is this worst case scenario here of the Nasdaq 100, we're actually over 12 months into the downward trend of the growth portfolio at the moment. So what I've done is I've consolidated these 2 years here into one bigger year. So instead of 17% down and 26% down, I've just done 1 year where it's 39% down. So I've kept the magnitude of the fall going forward, but I've shortened it, because if that worst case scenario was going to rhyme again, it's not going to last an extra year, hopefully. Who knows? Past performance does not predict future performance, does it? So I've shortened that, so that's helped the numbers a bit as well. But I played around with this spreadsheet, and I messed around with these two cells here, and I realised that 6 grand being taken from cash and putting into the portfolio, so long as it was invested with a half decent yield, would be safe, and it would still only, this worst case scenario here isn't too bad. To be honest, I struggle to spend anyway, so I'm on track for this year probably to spend about, this year here includes 2 cheap months when I was still in the caravan, but it also includes this really expensive month where I spent a load getting myself ready for travelling. I bought a brand new laptop, I bought a laptop case, I bought a bag and another bag that ended up not using. So, I've spent a lot in this month, but then even if you average out that mega expensive month to June, which we're in now, this is a pretty good estimate of what I'll spend in June. It's still only averaging at 1,271. If you multiply that by 12, it's 15,252. So this spend column here, I think, is pretty generous to myself. So that is another reason why I felt pretty confident taking more cash and putting it in the portfolio. So that's what I did today. I put it in the portfolio on the 8th, and then I finally got, there we go. On the 8th, I put it in the portfolio, so it's been measured as cash. And then today I finally got round to deploying it. So I put about $3,000 into BlackRock Smaller Companies because that yield's pretty damn high compared to its history. And then I put more also into Hypnosis Songs, yield of 6.51%. Now overall, that's not it's not massively increased this number, the total income for the year, because it reduced the cash interest obviously, and the cash interest at the moment isn't far off the average of those two investments. That's got to be somewhere near 4%, hasn't it? And I'm getting 3.95% on my cash, so it hasn't increased that number by very much. But what it should do is, in the modelling, it's the dividends are increasing by 6%, but the cash interest is not increasing at all. So it's increased the future year's income rather than increasing this year's income. But that's pretty good. And it's increased my dividends from 11,555 to 11,840, so about 285 quid. And that also includes the few pounds that I lost on the Murray International dividends, because obviously when you sell stuff outside of the ISA and buy it inside ISA, SIPs and LISAs, you pay stamp duty and you pay fees for the transactions. So I've now got fewer shares, not very many. So I've probably lost, I can't remember exactly, I've probably lost about a £5 in total per year in income by just moving all of that Murray International over the past few weeks and months. So I picked, like I said, BlackRock Smaller Companies done really badly. There's all doom and gloom about the UK economy and everything, but I was looking through the top 10 holdings. They're still increasing their dividends by like 10-15%, like the top 10 holdings are for this trust. But the share price is down in anticipation of future problems, so the dividends still going up now isn't necessarily a sign that there's no trouble coming. And so my track record isn't good, so I wouldn't be surprised if this did really badly from now on. Same with Song, but Song's just so depressed share price wise. I wonder if someone might catch a bid from private equity or something. It's so down, and I think a lot of that is because of the debt and the high interest that's on that debt. You can't trust these net asset values, but if you go based on the net asset values, it's at like a 50% discount to its net asset value. Look at this chart, the NAV keeps going up and the share price keeps going down, and I do think it's because of this gearing. Because this gearing here, that's 29% of the total assets, which is based on the NAV. If you did gearing in compared to the market cap, which is based on the share price, which is based on the market's opinion of how much it's worth, the gearing will be massive. It would be like, at least double that. It would be at least 60%. The gearing would be if it was calculated based on the market cap. And who's to say that the market cap is any more wrong than the NAV in terms of what the true fair value is? There's no such thing as a true fair value. It's just what someone's willing to pay for it, isn't it? So there we go. I've put a good case for not buying it, haven't I? Even though we just bought it today. So there we go. It's yet another stupid decision by me, probably. by spending, if I could get away with spending this much instead of spending this much, so this is how much I anticipate the dividends and my cash interest to be each year. That's the projection, and that's how much I think I could spend if I wanted to. The difference is, though, this spend here increases by 2% in this model. That's what the number of entered there is 2%. Whereas this one increases by whatever the dividends increase by, and however the interest changes, which is currently 6%. So I feel a lot better about having a lower standard of living and getting by on this number, and then having a steady progression in what I can spend, like in real terms, rather than just a 2% increase each year, which at the moment isn't even real term increases. Just to show you the sales of Murray International, here's how they affect my capital gains for this tax year. So I've made about 3,185. Now I think I've got about 1,927, some random number like that, left of my ISA allowance this year. So I'll probably just wait for some dividends to come in, and if I get about £1,000 worth of dividends and BlackRock Smaller Companies is still roughly where it is in share price, then I reckon I can probably get that moved into the ISA this tax year using the last bit of the ISA allowance. Alright, thanks for tuning in. I'll see you next time. Bye bye.